Imagine the U.S. stock market. The absolute unstoppable juggernaut of the last decade, the engine of global wealth, just suddenly plunging to 20th place globally.
Yeah, I mean, it sounds completely impossible.
Right. But if you look at the international data from BlackRock this morning, that is exactly the reality we are waking up to in these first few months of 2026.
It really is. It's a total shock to the system.
I mean, South Korea is up over 70%, Spain is up nearly 50%, and the United States is just lagging far, far behind.
It is a complete inversion of everything the market thought it knew like 6 months ago.
Exactly.
The models were projecting smooth sailing, and instead we are seeing this violent restructuring of global capital.
Okay, let's unpack this. Welcome to the deep dive. We know you're here because you're that quintessential learner, right?
You need to be well informed.
Yeah, you want the big picture, but you absolutely do not want to drown in information overload. So today, consider us your personal Wall Street analysts.
We've got a lot to cover today.
We really do. Our mission is to take this massive stack of outlooks from the absolute heavyweights. We are talking UBS, BlackRock, Fidelity, Charles Schwab, and M&I, and just, make sense of this chaotic start to 2026.
Which has been wild.
Truly wild. We're going to break down which sectors are suddenly winning and losing. We'll unpack the dramatic macroeconomic shifts that are delaying Federal Reserve rate cuts.
And we'll impartially examine the market impact of the escalating Iran conflict, too.
Right. Plus, we'll reveal exactly what top pundits forecast for the rest of the year. Let's start with the vibe shift, though.
The vibe shift is huge.
Because the data shows a massive migration of money. The Magnificent Seven tech era, which, it felt invincible, right? It's stumbling hard.
Yeah, the tech sector is down 4.6% year to date.
Which is crazy. Adobe just plunged 7.6%. But then you have consumer staples.
Yeah.
The companies selling toothpaste, groceries, paper towels. They are up an incredible 13.2%.
And Wall Street is calling this the Great Defensive Pivot.
The Great Defensive Pivot. I like that.
That phrase captures the psychology perfectly, I think.
Yeah.
We are watching a rotation away from the abstract promises of the future and toward the tangible physical economy of today.
Makes sense.
Because for the last few years, investors were perfectly happy to throw billions at big tech because of the artificial intelligence boom.
Right, the AI hype train.
Exactly. It was an era of massive capital expenditures. Tech giants were buying chips, building data centers, and just promising this utopian AI future.
But Wall Street is notoriously impatient. They don't want promises forever.
Precisely. The exhaustion set in because investors are demanding to see actual profit margins now.
Show me the money.
Yeah. They want to know how a $10 billion data center translates into real-world revenue this quarter. And when those AI margins didn't immediately materialize in a way that, justified the astronomical stock prices.
The capital got nervous.
It got very nervous. It started looking for safety. It started looking for predictability.
It's like everyone was at this ultra expensive, flashy VIP nightclub that's big tech popping bottles of AI hype.
Oh, I love this analogy.
Right. And suddenly the music stopped, the lights came on, and the entire crowd just rushed out to go sit in a brightly lit, reliable 24-hour diner where they just want a standard cup of coffee and some eggs.
Yes.
And that diner is consumer staples. So why is everyone suddenly craving the diner?
Because the diner doesn't care about a paradigm shift in computing. People just need to eat. And the data from Silvercrest Asset Management confirms this flight to the diner.
What are they seeing?
They highlight that the underdogs of the market are winning. Small cap stocks are up 6.0% so far this year.
Wow.
While large caps are up a measly 0.65%.
We should probably clarify those terms for anyone who doesn't stare at stock charts all day. Market capitalization, or cap, is just the total dollar value of all a company's shares.
Right, exactly.
So large caps are your massive trillion-dollar tech behemoths. Small caps are much smaller, often domestically focused businesses. So why are the smaller guys suddenly beating the behemoths?
Well, because small cap companies are often much closer to the tangible economy. They are regional banks, domestic manufacturers, local service providers.
As nuts and bolts of the economy.
Right. When global tech valuations become dangerously bloated, money flows down the market capitalization ladder to find companies that are priced reasonably and actually turn a consistent physical profit.
But this AI exhaustion is really only part of the story, right?
Yeah, it's a secondary symptom. The primary catalyst driving everyone into that 24-hour diner is a geopolitical shock that is completely rewriting global supply lines.
This brings us to the Middle East. And we need to look impartially at the facts on the ground here because the situation has escalated dramatically.
It really has.
U.S. Defense Secretary Pete Hegseth recently announced the largest wave of U.S. strikes against Iranian targets. And functionally, this has cemented a blockade of the Strait of Hormuz.
Which is massive.
For context, the Strait of Hormuz is one of the most critical energy choke points on the entire planet. Roughly a fifth of the world's daily oil consumption passes through that narrow strip of water.
And the market reaction has been swift and honestly violent.
Yeah.
According to Zacks Investment Research, crude oil is up 43% since the conflict broke out.
43%.
Yeah, and year to date, it is up a staggering 68%.
See, originally the models didn't account for this level of disruption at all. UBS had projected a base case scenario where we might see targeted strikes with only brief disruptions.
Right, they thought that would keep oil in a comfortable $60 to $70 a barrel range.
But a prolonged blockade changes the math entirely. Zacks asks a genuinely terrifying question in their research brief. What happens at $200 a barrel?
Which changes everything.
Because at $200 a barrel, we're no longer talking about a soft landing for the U.S. economy where things just slow down a bit. That scenario shifts us directly into a structural crisis.
Well, energy prices touch literally everything.
Hmm.
Every product in your local grocery store has to be transported.
Right.
When diesel costs double or triple, those transportation costs are passed directly to the consumer. That drastically impacts corporate profit margins across the board, which is why historical context is so vital here.
So when we look at massive oil shocks, the immediate parallel is the 1970s, right? Have we experienced something like this before?
The 1970s is the classic example.
The era of stagflation. High inflation, but stagnant economic growth. It's a nightmare for central banks because if they raise interest rates to fight the inflation, they crush whatever tiny bit of economic growth is left.
Exactly. That is the dominant fear.
Yeah.
However, New York Life Investments provides a totally different and highly counterintuitive historical parallel in their 2026 outlook.
Oh, what's that?
They argue we should actually be watching out for severe deflation, reminiscent of Japan in the 1990s.
Wait, hold on. I have to challenge that. If oil is $200 a barrel and my grocery bill is skyrocketing because transportation costs are through the roof, consumers don't have the luxury of hoarding cash.
That's true.
You are spending everything you have just to survive. So how does that translate to saving money and causing a deflationary spiral?
It's a great question, and it really comes down to the mechanics of demand discretion. You're right that people will spend everything on essentials. But what happens to everything else?
Oh, I see.
If all your money goes to gas and groceries, you stop buying clothes, you cancel vacations, you don't buy a new car.
Right.
That is demand destruction. The businesses selling those non-essential items see their revenue fall to zero. To survive, they slash prices to attract whatever few buyers are left.
And when that doesn't work?
They lay off workers. Those newly unemployed workers stop spending entirely, causing more businesses to slash prices and lay off more people.
A vicious cycle.
Exactly. The fear of losing your job makes even the people who do have money stop spending and hoard whatever cash they can. The entire economy grinds to a halt, and prices for non-essentials collapse so fast that it offsets the rising cost of energy. That is the 1990s Japan scenario.
That is incredibly bleak. So we are walking a tightrope between 1970s stagflation and 1990s demand destruction deflation.
It's a very precarious position.
And this directly impacts your wallet as a listener. If you are waiting to refinance your house or hoping to take out a car loan expecting interest rates to drop this year, the Federal Reserve's playbook has been completely torn up.
Completely.
Entering 2026, markets were priced for a Goldilocks scenario, growth without inflation.
But New York Life explicitly warns that that Goldilocks scenario is now the least likely outcome. The new reality they're forecasting is inflationary growth.
Let's break down why that stops the Federal Reserve from helping you out. Because the energy shock makes inflation sticky, meaning it refuses to drop down to the Fed's 2% target.
Right. It is currently hovering near 2.9%.
And because inflation is stuck there, the Federal Reserve simply cannot lower borrowing costs.
If they cut interest rates while oil is surging, they risk pouring gasoline on an inflationary fire. We looked at the M&I Fed preview, which tracks the consensus of sell-side analysts.
And what are they saying?
The expectations for a rate cut have been dramatically pushed back. We may not see a single rate cut until 2027.
Which means mortgage rates stay high, credit card interest stays high, and corporate borrowing remains incredibly expensive.
And that delay in rate cuts has a profound mechanical effect on the stock market. Fidelity points this out in their 2026 outlook, warning investors to watch the 10-year Treasury yield very closely.
Okay, what are we watching for?
The absolute key threshold to watch is 5%.
Why is 5% the magic number for a Treasury yield?
It comes down to a concept called the equity risk premium. Essentially, buying stocks is risky. You can lose your money.
Obviously.
So to convince you to take that risk, the stock market has to offer a potential return that is significantly higher than a completely safe investment. U.S. Treasury bonds are considered risk-free because they're backed by the government.
So if the 10-year Treasury yield hits 5%,
Institutional investors look at the stock market and say, why would I risk my capital in stocks during a geopolitical crisis when the U.S. government will guarantee me a 5% return for doing absolutely nothing?
that makes total sense.
When that yield hits 5%, bonds become a vacuum, sucking capital out of the stock market and triggering massive equity sell-offs.
Okay, let's unpack this. Here is where it gets really interesting, though. We have this massive geopolitical fear, we have sticky inflation, we have frozen interest rates, and the threat of a 5% Treasury yield.
A lot of headwinds.
Yeah, yet the U.S. economy itself is throwing off bizarre signals. In Q4 of 2025, GDP was incredibly weak, growing at an annualized rate of only 0.65%.
Largely due to a government shutdown drag.
Right. But Q1 of 2026, the tracking data shows it bouncing back to a hot 2.7% growth rate. How do we square a hot economy with all this panic?
You square it by looking at what is driving the growth versus what is restricting it. We have a hot economy fueled by consumers who are remarkably resilient and still spending on tangible goods.
Okay.
But that economy is restricted by high borrowing costs. When you have high rates, growth stocks, like the tech companies that rely on cheap borrowing to fund future innovation, suffer deeply.
Because money isn't free anymore.
Exactly. The mathematical present value of their future earnings drops. Meanwhile, a company selling paper towels or running a grocery store doesn't need to borrow billions to fund research. They make money today.
They are that diner.
Yes. The hot Q1 GDP numbers, combined with high interest rates, perfectly explain why the market is aggressively rotating out of high-valuation tech stocks and into defensive, dividend-paying sectors.
The market is adjusting to a world where, yeah, money is no longer free. Knowing all of this, the ultimate question for you listening right now is, how do you navigate this?
The million-dollar question.
So, how are the heavyweights advising you to position your portfolio for the rest of 2026? Instead of just listing off firm opinions, let's look at the underlying strategies they are recommending.
And the primary strategy right now is defensive positioning.
Right. When we look at defensive positioning, Charles Schwab's latest outlook heavily upgrades healthcare to most favored status. And there is a very specific mechanical reason for that.
Pricing power.
Yes. Explain pricing power in this context.
Pricing power is a company's ability to raise prices without losing customers. In an environment with sticky inflation and high energy costs, companies have to charge more.
Right.
If you sell luxury watches and raise your prices, people will simply stop buying them. But healthcare, medical treatments and pharmaceuticals are non-negotiable for survival.
You can't just skip your heart medication because it got expensive.
Exactly. Healthcare companies can pass those inflationary costs directly onto consumers or insurance providers without seeing a drop in demand. Their profit margins are protected by the essential nature of their product.
That makes perfect sense for a defensive play. But Schwab and LPL Financial are also heavily upgrading industrials. Heavy machinery and manufacturing don't sound defensive. They sound highly sensitive to the economy. What's the mechanism driving the industrial sector?
The mechanism there is direct government intervention. LPL Financial points directly to the newly passed One Big Beautiful Bill Act, or the OBBBA.
We should probably mention, just to be clear for our listeners, we absolutely aren't taking a political stance on the OBBBA here. We are strictly looking impartially at LPL Financial's data on how this legislation functions mechanically within the market.
Right. No endorsements here. From a purely mechanical standpoint, the OBBBA injects roughly $130 billion in business tax cuts into the economy, heavily targeting manufacturing and defense.
That is a massive chunk of change.
It acts as a massive fiscal stimulus directly into the veins of the industrial sector. Furthermore, even if AI software stocks are taking a hit right now, you still need industrial companies to physically pour the concrete, build the data centers, and upgrade the power grids required to run AI infrastructure.
That's a great point. Energy and cybersecurity are also seeing massive inflows. ETFs tracking cybersecurity, like CIBR, are surging because modern geopolitical conflicts and blockades aren't just fought with ships, right? They're fought with digital attacks on infrastructure.
Absolutely.
And for the ultimate historical defensive play, UBS strongly recommends allocating to physical gold. They're actually forecasting gold to hit $5,900 an ounce as a direct hedge against this geopolitical volatility.
Which is a huge target.
So those are the winners. Where's the smart money pulling out? Who are the
The
losers?
strategy of avoiding high capital expenditure and debt vulnerability dictates the losers. UBS has downgraded information technology and communication services down to neutral.
Wow.
Yeah, the costs to maintain that infrastructure are just too high right now. Meanwhile, Schwab is putting consumer discretionary and real estate in their least favored category.
Well, consumer discretionary goes back to that demand destruction concept we discussed earlier. If you are paying $200 a barrel for oil, your gas and grocery bills eat your entire budget. You aren't buying non-essential goods.
Right.
But why is real estate in the least favored category?
It's crucial to understand what we mean by real estate here. We are largely talking about REITs, or real estate investment trusts.
Okay, what does that look like mechanically?
A REIT is basically a company that owns and operates income-producing real estate thinking, massive commercial office parks or giant apartment complexes. To acquire those massive properties, they rely on enormous amounts of debt.
Ah, and if the Fed isn't cutting rates?
Exactly. If the Federal Reserve isn't cutting rates until 2027, the financing costs for these REITs remain brutally high, which just eats their profits alive. Combine that debt burden with the ongoing structural shift of people working from home and leaving office buildings empty, and the sector is highly vulnerable.
But despite all of this turbulence, the wars, the sticky inflation, the sector rotations, the empty office buildings, the broad outlook from Wall Street is surprisingly resilient.
Yeah, it's not a doomsday scenario.
No, it isn't. UBS remains genuinely optimistic. They're maintaining a year-end S&P 500 price target of 7,700. They actually anticipate global equities to rise over 10% by year-end as this market rally broadens out.
It just isn't going to be led by 5 tech companies anymore.
Right. BlackRock echoes that need to broaden out, don't they?
They do. Their core advice for 2026 is geographical diversification. They are urging investors to look beyond U.S. borders to places like Europe, Japan, and emerging markets.
So the days of lazy investing are over.
Pretty much. You can no longer just blindly buy a U.S. index fund, sit back, and let a few tech megacaps inflate your portfolio. Active defensive management is required.
So what does this all mean for you? Let's recap this deep dive. 2026 is rapidly being defined by the sudden dominance of the tangible economy. The 24-hour diner is beating the VIP nightclub.
Every time.
We are dealing with a highly volatile geopolitical landscape, specifically the Iran conflict and the Strait of Hormuz blockade, which threatens to send oil skyrocketing.
Which keeps inflation sticky.
Exactly. That energy shock keeps inflation sticky, which has tied the Federal Reserve's hands, pushing any relief on borrowing costs out to 2027. It means it is time to check your blind spots, look internationally, and recognize that the market's leadership has fundamentally changed.
And while human analysts are sweating over macroeconomics, inflation data, and geopolitical blockades, we'll leave you with one last, genuinely mind-bending concept from an ArtSIF research paper we pulled.
Oh, this part is wild.
During this exact period of intense market volatility, while human traders were panicking about oil and rotating out of tech, an AI trading bot was quietly running in the background.
Just doing its thing.
Right. It didn't look at shipping lanes or interest rates. It utilized social media sentiment analysis. It simply read the emotional mood of the crowd online.
Or how did it do?
By doing that, this AI successfully generated an 18.4% net return,
18.4%.
comfortably beating a standard buy-and-hold strategy, even after transaction costs.
That is insane.
So the thought we want to leave you to ponder is this. In a market driven increasingly by geopolitical fear, inflation anxiety, and sudden narrative shifts, will the machines eventually become better at trading human panic than humans themselves?
Think about that next time you sit down at the diner. We'll catch you on the next deep dive.